All right, I can see we got 16 people here, missing a couple more. And then we will get started in our final session here in about a minute. Okay, so as we're about to get started, do we have one of the four teams that would like to volunteer to go first?
Professor, I think our team can go first.
Okay, which team are you guys?
Team CVS.
CVS? Okay, are you going to be the one that's going to be presenting?
Yes, sir.
Okay, so basically what we'll need each of you to do that's going to be presenting is on the bottom menu of the Zoom window, there should be a share button. You can just click on share and either share your screen or share your PowerPoint file or PDF, whichever version you had. And so the way that we'll get CVS going in just a minute, but basically what's going to happen is each team will have approximately 15 minutes. So at the end of 15 minutes, I will ask you to kind of wrap it up. I'll use my kind of iPhone countdown timer to keep track of time. I'll generally try not to interrupt you with too many questions, but I'll probably hold them until the end of your presentation, and then we'll go through all four teams. I will then kind of look at what I've done tonight, put the scores on, and then you'll see your overall grades pretty quickly for this. Each of the sections is worth 10 points, 40 points total for your evaluation project. So looking forward to hearing from each of you. And again, if multiple people are presenting on behalf of your team, that is fine. And just as a reminder, we are recording this session as well. So unless anybody has any questions, I'm going to set up my countdown timer. For 15 minutes. And CVS, you guys are on the clock.
All right, good evening, everyone. This is our corporate valuation project on CVS. This is the agenda we'll be following. First, to introduce the team, we will be having Mike Godlewski on our team, Rebecca Salazar, Sean Griffin, Phil Hurst, April Webb, and myself, Ronnie Vonai. Leading us first into the CVS background and financial analysis will be April Webb.
Thank you, Fran. So the overall goal of our EIC analysis is to help everyone understand just how our industry of retail and wholesale fluctuates and sensitive to the economy, but more so how CVS is sensitive to any movement in the economy. So I draw your attention to the graph here on the left. That's our long-term economic forecast. There we're going to focus in on key indicators to help us understand what this economy is going to do in the future. Starting with the real GDP. Notice how from 2019 to 2021, it's going to drastically go down from 2.5 to 1.8. Similarly with consumer spending, it's going to follow the same pattern from 2.7 to 1.9. Another indicator, consumer pricing index. That's helping us understand the pricing variances going from 1.9 to 2.2, suggesting that we're going to have an inflation in the market, meaning pricing is going to go up, but the overall value is going to go down. Finally, the probability of recession. If you remember from the first session, the professor had noted how over the course of time, that percentage has increased. And if anybody has paid attention to the economy, we usually have recessions every 10, roughly to 12 years. So right now, people are anticipating something happening. And you will find out for this specific industry, they've actually been told by Bloomberg, by Obvious World, that they're actually recession-proof. So the next indicator, I want to bring you to the middle graph, our economic surprise index. This helps us see just how our actuals are doing in relation to the forecast data. So right now, overall, the economy is underperforming by 0.38. And then more so importantly for the retail and wholesale industry, notice this large red bar? That's the one we're talking about. They are dramatically underperforming. So these are key indicators we need to pay attention to when we're talking about the valuation and the projections of CVS. Now, finally, on the far right, we want to understand the risk factor. How do we expect the industry to perform to any 1% of economic movement? So right now, this industry is looking at a 1.05. So for every 1% economic movement, they are a little bit more sensitive when we look at that raw beta. And then also when you look at CVS more specifically, they're at 1.36, suggesting that they're even more sensitive to any 1% economic movement, and then even more sensitive in their industry by 0.31%. Next slide, please. So the industry, we want to understand, is this attractive market and why? So first I want to draw your attention to the statistics. Right now, this industry is roughly about almost $300 billion in revenue. That should make something go off in your head. They are banking. Not to mention the profit margin at 16.9 is roughly a little bit under 6%. I don't know about you, but in my market sector, I only make roughly 4% profit. So they are doing well. Another indicator, looking at the annual growth. Historically, you can see here, they have been performing. Over the more specifically, over the past 5 years, they've been at 2.6%. And in the projected 5 years to come, they're looking at a 2.4%, showing us that this is a market that is still showing growth as well as sustainability. Then when you look at the operating spread, the graph here on the left, that's where you need to understand their invested capital versus their cost of capital. How are they doing there? Right now, they have slightly under 1 point. The key to understand is that it is positive and there is a good spread. So not only is this industry attractive, but it is very attractive. Next slide, please. So based upon the data we just went through, we want to understand, what do we expect to happen in the future? Will the spread grow? Will it decrease? Or will it stay the same? So again, keep in mind, we've already talked to the growth factor at being a sustained 2.4%. So that is a key indicator. Now, understanding how the Porter's five forces impact this, you have companies such as CVS who have strategically put themselves in position to ensure that this industry will combat these forces. So barriers to entry. Right now, they're at a medium level. But according to, like I said, Bloomberg, IBISWorld, they're all saying this is due to increase. However, people like CVS and Walgreens have done strategic consolidation and vertical integration by acquiring companies such as Aetna and Boots Alliance to combat this so that other companies cannot enter. Not to mention, they're able to increase their overall market share, grow their size, economies of scale, and increase their product offerings, therefore combating people who have entered, such as Amazon. Not to mention, because of this acquisition to a company such as Aetna, they're able to negotiate better rates of reimbursement with the pharmacy benefits managers, or your PBMs. Next slide, please. So understanding competitive advantage. Previously, I showed on the slide the operating spread of CVS was a negative. They had a 1.88 rate of invested capital versus a WACC of about 7.37. So yes, negative. They understood that. That's why they put themselves in position to do that strategic acquisition of Aetna. So now they're in a totally different stratosphere, and you'll hear more about this in the continuation of the presentation. And that's why they have these projected statistics, meaning their growth rate. They're projecting they're going to have a long-term growth rate of about 3%, which is higher than the industry showing 2.4%. Not to mention, when you compare that to the GDP, they're suggesting GDP is going to go down, so showing they are going to outperform. Same thing with the profit margins. Because of this increased product offering and efficiencies as well as innovations, they're going to be able to increase their profit margins by investing more money in on-site as well as online product offerings, and then understanding where they're going to get dinged. Tax rate. They have a higher tax rate than the industry. They're at 26%, whereas the industry is at 22%. And then their WACC, again, because of this invested into the online and then the on-site locations, they're going to have a higher cost of capital. But overall, due to these contributing factors, they are going to have a higher ROIC. And because of that, we believe that their spread is not only going to be positive, but is going to be higher than the industry at a roughly 2.06%. Now, the reason why I pointed out the challenges for CVS, more recently, there was an article that came out in the Wall Street Journal as to why people like Walgreens and CVS had to reproject their earnings and decrease them because generic drugs are putting a squeeze on their profit margins, mainly because historically, the pricing for generic drugs have gone down, causing them not to get back as much reimbursements as they would like. Next slide, please. So in the end, regarding how they're going to be able to not only keep the competitive advantage, and this is showing you right now how CVS is the front runner in their industry. Notice how they're at 24%, in addition to the fact that they have the Aetna acquisition. But because of this strategic plan, they will continue to have competitive advantage through acquisitions, buying the market, working reimbursement rates with the PBMs, continuing increasing their product offerings, not just with healthcare, but as well as innovations, and this in turn will make them more productive as well as higher profit margins. And now Phil will talk to you about their historical financial analysis.
Thanks, April. So to start the 5-year historical financial analysis, we look at the ROIC tree, and starting at the left, we see CVS's ROIC has gone down from 9.6% to negative 1.3%. This is a large decrease of 113%. So to look further, we first look at the tax rate, which we can see went up 260% from 39.5 to 142.4. Second, the operating margin decreased 67.3% from around 6 cents to 2 cents. So this means that CVS profitability decreased, which contributed to a decrease in ROIC. Looking further at the operating margin, we see gross margin went down 10% from 20 cents to about 18 cents. And SG&A increased 19%. Depreciation remained relatively flat with only a slight increase of 0.8%. So to summarize the operating margin, it decreased 67.3%, which was due to an increase in SG&A and decreases in gross margin. Looking at the last driver, invested capital to sales, this indicates the productivity of CVS over the last 5 years. We see invested capital increased 64.8% from 40 cents to 65 cents. In other words, in 2014, CVS generated $1 worth of sales by investing 40 cents, but in order to generate the same dollar worth of sales in 2018, they were investing 65 cents. This means they were less efficient in spending more to drive sales. So looking further, we see that operating working capital decreased 95.5%. We also see a decrease of 8.1% in PPE, which shows that CVS was spending less on facilities over this time frame. This would actually help invested capital to sale in isolation, but we see a large increase in intangibles of 117.6%, from around 27 cents to 59 cents. This shows that CVS increased its acquisitions substantially over these 5 years, largely driven by the Aetna acquisition. So looking across all three drivers, we see CVS had a decrease in ROIC of 113% from 2014 to 2018, driven by a higher tax rate, lower operating margins, and lower productivity. So I'm going to pass it on to Sean now to talk about the CFI.
Thanks, Phil. On the screen now, you'll see a 5-year CFI analysis for CVS. And the first thing you'll notice is that we're steadily increasing gross cash flow from 2014 to 2017, which is a good sign of a healthy underlying business. But the next element you'll quickly notice is that the 5-year free cash flow is negative, which begs the question, what happened to the significant cash that the company generated over the 5-year period? The most important aspect to note about this in CVS's use of free cash flow is the company's ambitious growth strategy fueled by acquisitions. In 2015, on the CFI analysis, there was $14 billion in goodwill related to the Omnicare pharmacy acquisition, which is a provider of pharmaceutical products to long-term care facilities, such as retirement homes. And in 2018, there was 63 billion that showed up in the CFI analysis related to CVS's acquisition of Aetna that April referred to in detail earlier in the presentation. In years with no acquisitions, the company had positive free cash flow and CFI. Outside of acquisitions, the company shows their priority that they place on PE metrics and steadily improving those metrics over time by using a large portion of free cash flow to issue dividends and repurchase shares. Over the 5-year horizon, 8.8 billion was used for dividends and 17.8 billion was used for share repurchases. So with fewer shares outstanding, the EPS metrics are increased, which is obviously a significant priority for the company's management team. The company also added to its stockpile of excess cash by increasing that by $1 billion over the period. When you see a company that has positive cash flow, gross cash flow, such as CVS, you might guess that they would use a portion of that to reduce debt. But actually, the inverse of that has happened, given the company's aggressive growth strategy. That actually increased by 60 billion, 2014 to 2018, to fuel the company's acquisitions and use of working capital. With that, I will turn it over to Rebecca to walk through the multiples.
Okay, so for our multiples analysis, we compared CVS to Cigna and Walgreens Boots Alliance. So our first multiple was to review the PE ratio, and unfortunately CVS is currently trading at a discount to both Cigna and Walgreens. And this is primarily driven by the low return on equity. You'll see they're at 19% versus 13% and 20% respectively, and the high cost of capital. So you can see they are their cost of equity is $11.50 compared to $9.40 and $9.80. So unfortunately, this is dragging them down. They do actually have the highest expected growth of 4.27%, but unfortunately, that was not enough to outweigh the other factors. For our second multiple, we looked at the EBIT, and they are also trading at a discount in this scenario at $9.69 compared to $12.94 and $12.18. This is primarily driven by the negative ROIC, which is at negative 188, whereas both of the other competitors are strong at 863 and 16.8% respectively, as well as the low growth rate here, also negative compared to positive growth shown by competitors. And really all in this drives a negative productivity at negative 222, which means that they're having to spend more money to see a return compared to their competitors.
Unfortunately, we just ran out of time at 15 minutes. So I'm going to give you the opportunity. I'm not going to ask questions. If whoever's going to do the valuation, I'll see my question time so you guys can finish.
Okay.
So you got about 2 minutes, though.
Yep. So we didn't want to base the past performance and hold it against them for future valuations. Since due to their new emergence in the healthcare industry and their shift into that business model away from retail to get a more healthcare-oriented model. This is a very profitable industry, and this grouped along with their plan to reduce underperforming areas in their stores with more healthcare services to reduce the retail aspect of it. We want to take this into account in our models. So for the bull forecast, we see that they had been doing share repurchases in the past, and they're talking about bringing that back after they get the Aetna acquisition completed. So we included $3 billion in share repurchases. We peaked growth at about 5%, steadily increasing with peaking at 5% through 2024. And then due to their wanting to, cut costs and make things more efficient, we increased the EBITDA to 7.7 and then a final terminal growth of 4%, which gave us a $91.34 share price. That's 69% increase from current levels. And then the assumptions for the bear, we assumed everything went wrong. Flat growth, rising costs, and no repurchases in shares, which ultimately brought the price down to 41.13, which is a negative 24% roughly in stock price. And then as a group, we decided to do a conservative approach to this. So we kept the share repurchases due to their steady, positive free cash flows generated in previous years. And then the moderate peak in growth at 4%. And then we looked at them, cutting costs, so left that at about 7.6% EBITDA. and then a terminal growth rate of 3%, which brought our group target to 77.18. And ultimately, we believe since they are entering such a lucrative industry, we believe that the stock is a buy at this level.
Okay, great. Well, again, thank you, team. And I wish I had more time to ask some questions. So I'll just ask one quick question. It assumes in the bull valuation that what you guys talked about the pressure on generics is temporary and not going to affect them long term. Any thoughts on that?
We think it's a possibility that it could last long, in which it likely will. Since they're kind of shifting, I mean, yes, it's going to be a large portion of their revenues, but they're also shifting into a major, change of industry. So the healthcare services are definitely going to be their primary focus, and they've noticed the problems that are occurring in the actual prescription business. So they're trying to shift it away. So we wanted to kind of account for that.
So you're basically bull, and your target are based on the shift more than anything else.
Yes.
Okay, great. Well, again, just a little applause. Thank you guys, especially for going first. So thank you. All right. So CVS is now wrapped up. Who would like to go next? Any volunteers?
Royal Caribbean can go next.
All right. So Royal Caribbean, whoever is going to be your spokesperson, go ahead and share your presentation.
Okay, that is me.
And once you do that, as soon as you're ready, we will put you on the clock.
Sounds good. Give me just a sec here. Okay.
I see the presentation. That's a good sign.
Okay, and I got it a little fancier here if I can.
There we go.
Okay.
All right. You guys are on the clock.
Thank you, guys. Welcome, everyone. My name is Danilo DeAngelis. We are Royal Caribbean's group here. Along with myself, we have Ahmad Laripur, Anna Zajac, Romy Patel, Torian Isam, and Tom Kalazuk is part of the group. So again, yeah, we're doing Royal Caribbean, the cruise line. And with that, I will pass it over to Ahmad, who will get us going here. Ahmad, it's all you.
Hi, everyone. We started from EIC analysis. So the first step is economy. Economy analysis is important because good or bad economy can benefit or hurt a company. One of the indicators for economy is GDP. The forecasted GDP is 2.5, so it means 2.5% growth in GDP, and probability of recession is 25%. So the chance of recession is low, but if it happens, it would go to negative GDP, and in this way, it would hurt the company. Another important factor is beta. So beta is representative for economy sensitivity. The average beta is 1, so we can go to information by that number. First, the average industry is sensitive to change in economy. And second, since market beta is 1, so it moves up and down at the same speed as the market. The company beta is 1.28, so the company is more sensitive than average industry by additional 28%. So it means it moves faster than average industry or the market. So the next step is industry. Can you, next slide, please? Yeah, the next step is industry to determine the attractiveness of the industry. So ROIC for average industry is 22.5%, and cost of capital is 8.4%. So there is a positive spread of 14%. So the industry is attractive and profitable. And we use Porter's 5 forces for attractiveness of the industry. So I'll pass to Tom for the rest of the 5 forces.
Thank you, Ahmed. So the Porter's 5 forces starts with the power of buyers. Each member of the cruise oligopoly has entered most of the popular markets. Therefore, the power buyers of decreasing the price of cruises is relatively low, and most cruises offer the exact same experience. Next is the power of suppliers. Labor is one of the most high-cost supplies that are necessary to operate cruises, and in the current economy, there is high cost for for regular labor. So that makes the power suppliers low in terms of industry attractiveness. Barriers to entry refers to new companies spawning because of the high capital costs in the cruise industry based on the cost of ships, workforce maintenance. The barriers to entry are high, including the competition limiting revenue due to the major players achieving an economy of scale. Threat of substitutes is medium. IBIS World says that as there's a shift in GDP and economy, that there may be the threat of mid-scale hotels being a substitute for people's vacation choices. But that's why it's a medium risk. And the rivalry amongst competitors is high in terms of attractiveness because there's an oligopoly between the big three cruise firms, and they maintain the competitiveness, their stance in the oligopoly based on their acquisitions. If you go to the next slide, please. So final is the company analysis. We based our company analysis based on the ROIC of the industry and the ROIC of Royal Caribbean. As you can see in the chart below, that the ROIC for Royal Caribbean is well below the industry, and the spread is also below its major competitors, which are Norwegian and Carnival. So we think that the company has a long way to go, but we will go into the reasons why the ROIC is low compared to competitors in the following slides. Handing it off.
On mute.
Okay.
So right now we're looking at the 5-year cash analysis. So the first thing you can see is that the gross cash flow that RCL generated from their income statement was actually 11.4 billion. The gross investment was 8.6 billion, and this actually led to a free cash flow of 2.7 billion prior to acquisition. And after acquisitions of about 734 million, which was mainly their purchase of a 66% stake in a luxury cruise line by the name of Silver Sea Cruises, they actually had a free cash flow from operations of about $2 billion. One of the things that's important to notice is their reinvestment rate, which is 74%. So on average, they're reinvesting this percentage of their profits each year back into the company, which is leaving roughly 26% available for payout. And that reinvestment that they're doing is mainly in capital expenditures at $10.4 billion. And it appears that RCL may have known that they were going to be growing in the future, given that on average, they're actually investing 2.3 times as much into capital as they are in depreciation. And as we go down the sheet, you can see non-operating activities actually reduce their cash flow. So they, over the 5-year period, they actually received $106 million in interest income, but that was actually offset by their purchasing of $560 million in non-operating assets. So once you see the CFI, the next question is how do they distribute it? And you can see that they paid $1.4 billion out in interest. And then the company actually borrowed an additional $2.7 billion, which they used to pay dividends of $1.8 billion and to actually repurchase shares in the amount of $1.5 billion. And looking at the sheet historically, you can kind of see that RCL likes to reward their shareholders and kind of repurchase shares. So it makes sense that they're actually going about incurring debt, given that their CFI is only $1.5 billion. Next slide. Okay, so the ROIC analysis. So here you can see over the 5-year period that their ROIC actually improved pretty drastically from 5.7% in 2014 to 8.9%. And you can also see that the cash tax rate is actually 0%. And so Section 883 of the IRS tax code, which actually applies to foreign ship and aircraft companies, it actually exempts RCL from federal income taxes due to the fact that they're incorporated in Liberia. And this is really one of the biggest drivers you can see that's leading to kind of their high ROIC growth. Next, if you look at their OM, it also improved over the 5-year period from 0.117 to 0.2. The main driver here was a reduction in kind of their overhead costs by 8.4%. So SG&A costs actually fell from 0.752 for every dollar of sales in 2014 to 0.689 for that same dollar of sales in 2018. And also the growth margin was really slightly offset, I guess, by RCL's investment as a percentage of sales. So the productivity of their investment actually declined over the 5-year period from $2.05 to $2.24. and that was really driven by their PP&E costs. So those costs actually rose from 2.25 to 2.47, which is a 9.7% increase. So overall, the ROIC is doing really well, but as you see, it could have done a little bit better if they were actually able to improve their productivity with their invested capital. So with that, I'll pass it to Anna to kind of talk about
Hi guys, sorry about that. Anna's still kind of stuck on the train here, so she's unable to make it. So I'm talking here for her on her slide, and I'll move on to mine. So here's the multiples analysis for, I'm sorry, hang on one sec. All right, so here's the multiples analysis for Caribbean, and we compared them to two other cruise lines, Carnival Cruises and Norwegian Cruise Line. So here's the price to earnings multiple analysis, where you can notice that the model price to earnings and the observed price to earnings kind of matched up. You see that Royal Caribbean is kind of in the middle between the two companies. They're going at a premium compared to Norwegian Cruise Lines of 9.63 compared to 9.59. They're at a discount compared to Carnival Cruises. The difference in this can be explained by the spread based off of the ROE and the cost of equity. But the main driver here, you can tell, is cost of equity, which is why Carnival is at a premium compared to Royal Caribbean and Norwegian, who have a cost of equity at 11%, and the Carnival is at 9.4%. We'll go here. We can go to the next slide, which goes into the profit multiple analysis. So here is where we can again compare the other two cruise lines to Royal Caribbean. Biggest thing here is the EV to EBIT, and the EV to EBIT for Royal Caribbean is at a premium compared to the other two cruise lines at 14.07 multiple compared to 11.87 for Carnival and 11.75 for Norwegian. And the main driver for that is the growth rate. From what you can tell here, the growth rate of Royal Caribbean is at 6.49% to achieve that EV to EBIT, compared to Carnival at 0.47% and a negative growth rate with Norwegian at negative 2.7%. Another big driver was that we talked about in class was productivity, where you can see that productivity is much higher for Royal Caribbean here. At 2.31 for every dollar of sales compared to 1.82 and 2.04 respectively for Carnival and Norwegian. That kind of was offset by their much higher growth rate compared to its competitors, which allowed it to trade at a premium at EBIT to EBIT compared to the other two cruise lines. And with that, I will pass it on to Romy, who will, there we go, who will discuss the valuations. Romy?
Alrighty, thank you. So apologies in advance. I'm going to try to speed through this here in the next few minutes as quickly as possible just to get it in. So as this valuation, our share price was about 110. We got it to about 109.53, mainly focusing on EBITDA. After we did the EV to sales and EBIT calculations, we came to an operating margin of about 20.7%. So to kind of work backwards, we got EBITDA down to 31.6% by 2024 for perpetuity purposes. Revenues we kept pretty consistent moving forward at 8%, mainly because a lot of their recent acquisitions and their new land developments will be priced in by that point. And then just for the growth purposes, we got it to about 5.13%. Next slide, please. So Bull, we went pretty heavy here, mainly focusing on revenue catalyst and EBITDA catalyst. Starting with revenue, kind of three main catalysts there. One is consumer spending, second ship capacity, and third Asia. So there's a trend in consumer spending to kind of buy more towards service-based purchases versus goods-based. So they foresee with a large number of retirees kind of coming up here over the next decade or so, a lot more cruisers in the market. Also, the average spending on the cruise has been going up as well, almost about 6% over the past 15 years. So that's positive growth there. Also, ship capacity, as mentioned earlier, they did make a major acquisition of Silver Seas Cruises. So they are going to have about a 6.5% increase in ship capacity over the next 4 years as well. And they're also building a bunch of ships. Currently, they've got about 16 ships on order to give them a total of about 60 right now. And then also Asia is a huge market for them. They've kind of shortcut out of Europe just because of large ship supply there. And they're going to more transition towards that Asian market where there's just a larger propensity for Asian travelers compared to Europe. And then for EBITDA, main thing here is just profit margins with vendor negotiations, trying to consolidate reservation centers. And main one is just fuel usage. Over the past couple of years, they have been able to drop that down about 10% in 2016 and 5% in 2017, respectively. So if all things go well in those scenarios, we realistically can see a bull valuation of about $192 a share. Next slide, please. So worst case here, bear valuations, again, focusing on EBITDA. If fuel cost and their ship efficiencies don't go so well, assuming crude prices go up, and also to mention that their Silver Seas acquisitions, those ships are smaller. They only hold about 600 passengers, so they're also not as fuel efficient. So if they're not able to optimize those ships over the long run, then that can actually cost them more money, cutting down on their margins there, revenues. If we do go into a recession of any type here, especially within North America, there may be a drop in just overall growth. We're projecting from 8% in 2022 down to about 6% in 2024. And then also tax rates. I mean, it's probably unlikely, but if their tax rates do change and they actually do have to pay taxes here, that may be a headwind as well for them. So worst case, we are imagining a bear valuation of about $52 a share. Next slide, please. And more realistic target, about $141 a share, assuming EBITDA. Again, fuel cost, main driver here. Their estimated cost is about 7 to 8% of variable expenses, but based on CME futures, they're well hedged against those right now. Revenues, we're estimating a 7% consistent growth, mainly because of their acquisitions, as well as they have a new land process going on right now with Cocoa Bay down in Miami. So trying to get away from just on sea, but also create land developments as well. We don't foresee the tax rates really impacting them. With recent rate hikes, they are about 52% levered in long-term liabilities. So there may be a there could be a realistic change in their WACC. So just accounting for a 60 bips uptick, we were able to get their valuation to about $141. Next slide.
You need to wrap up in about 30 seconds.
Yeah, so I'm 30 seconds from done here. So this slide is just to kind of show those crude oil futures. Like I said, they are expected to go down over the next few years. Next slide. And lastly, we do have a buy valuation against Royal Caribbean here. Again, based on the target, we do see about a 28% uptick here within the next 12 months. And that is the end of our presentation. Any questions?
Yeah, it was good insights, and actually the tax thing really surprised me. So I really appreciate that, kind of like trivia question. But just out of curiosity, in your multiple analysis, and to some degree what you said here in the valuation, Royal Caribbean is growing a lot faster than the industry, than Carnival and the other player you mentioned. Any sense of why? Like they seem to be growing, the other two are not?
Yeah, so I don't mind taking that one. So when I was kind of working on the valuations, one thing I did notice was that where Carnival is their major kind of main competitor, kind of Norwegian's kind of third in line, if you will. But one thing I did notice was kind of where their cruises are. Carnival is very heavily concentrated within Europe, is where they're getting a lot of their berths from. And as I mentioned earlier, a lot of Europe is kind of very heavily saturated right now. That's why Royal Caribbean actually, I think, cut their stake in Europe by about 23%, if I'm not mistaken, over the past year or two. And they're trying to focus more on the North American markets. And then, like I said, also develop over in Asia. So that was one thing I noticed.
So they're kind of soaping up the growth where their competitors are not, is really what you're saying. They're sopping up.
Yeah. So one thing I saw, like I said, with Asia is that, overall they have a much larger number of foreign travelers outside of China than even North America does. But there's been some kind of like political issues going on between them, Korea, and some of the other kind of neighboring countries. So they've had to cut back on cruises there, but they foresee some regulation changes, making that a little bit lighter for them so that they could actually set sail to some of those ports in that area.
Right. And simultaneously, the slowdown in China, just in their growth and potentially the slowdown in economies, you're not worried about the beta impact on them? Because they're pretty high beta at the beginning of your EIC presentation.
Yeah, so they're definitely higher than the normal of one. Realistically, I mean, the Asian market is still kind of a high spending market, and so as much wealth as there is there, and the number of potential travelers, I don't foresee kind of the trade kind of negotiations that are currently going on impacting it as much. Just because, like I said earlier, there's still a large number of travelers. So if you just base it, by head count, even if they kind of sail their regular number of ships right now, which is that they only have about 3 or 4 ships out in that area. So as long as they can keep those at capacity, they should still be fine.
Okay. All right. Well, again, great job, team. Good insights on Royal Caribbean. So appreciate it. Okay. We have Nike and Halliburton. So who wants to go next?
We'll go. Halliburton.
Halliburton. All right, Halliburton. And then who is going to lead the presentation?
I'll lead it.
All right. And if you can just find your share button.
Yeah.
Bottom of the screen.
All right, so we'll be doing Halliburton, and we're just going to jump right into it. So I'm going to hand it off to Christian to talk about the economy and the industry.
Awesome, let's do it. So just to give a little bit of background, because people might not be as familiar with Halliburton as some of the other companies that are being presented. Halliburton operates in the global upstream oil and gas industry, and they offer a wide array of products and services within that space. They do everything from manufacturing drill bits and what they term other downhole completion tools, so basically everything that's underground. They provide pressure pumping services, help locate reserves, they manage geological data, they drill new wells, really everything up until refining and distribution. They currently have about a 14 to 15% market share of the industry, and for the sake of size, they have about 55,000 employees in 70 countries. Next slide, please. So not to beat a dead horse here, but there really is no surprise that the fossil fuel industry is highly elastic to changes in the broader economy. So we kind of wanted to highlight some points here. To summarize, all indications really are that things aren't looking so hot. The World Bank's Jan 2019 Global Economic Prospects showed that growth among advanced economies is forecast to drop to about 2% this year, with emerging markets bringing up the rear 4.2%. In the aggregate, the IMF thinks that global growth is going to be around 3.3% on the whole. However, it's worth noting that 3.3% was the IMF actually downgrading 2019 growth from 3.5%. And last Thursday, we had the ECB downgrading its economic growth expectations from 1.1% from 1.7%. On the domestic front, we're kind of slipping out of the sugar high from the Trump tax cuts. So things really aren't looking so hot. The only bright spots really are the emerging markets, which use predominantly fossil fuels and not really into renewables. Growth is primarily going to be in Southeast Asian countries. That's going to be up 7.1% in 2019. In India, really shining in that space is forecast to grow about 7.3%. Next slide, please. Oh man, we're giving up time. So this slide is basically intended just to show that the Federal Open Market Committee projects that through 2021, we're going to see GDP growth in the U.S. drop to 1.85%. So not looking too hot there. Next slide. I kind of want to just focus on this. It's a prime indicator of forthcoming recession. And again, that highly impacts fossil fuel space, spread between the 3-month T-bill and 10-year Treasury. It's been hovering around 0. It was inverted briefly. It's a classic indicator of upcoming recession, which of course is going to heavily impact the demand for fossil fuels with a beta of 1.2. Next slide. That just translates over to what's about a 27% chance of recession. I know another team showed a similar number in Bloomberg previously. So just to kind of reiterate that point. Next slide. Kind of transitioning into the industry driver space, I wanted to focus on the strength of the U.S. dollar. It's actually something that's kind of a boon to Halliburton in the fossil fuel space. Morgan Stanley estimates that the dollar is overvalued about 15%. Since commodities are priced in dollars and the U.S. is really now a predominant producer of fossil fuels, we might actually see a demand increase when oil becomes cheaper if the U.S. dollar reverts back to the mean. So if that's the case, U.S. economy slows down, we might see demand pick up as a result, which translates over to a increase in demand for Halliburton services. Next slide, please. So as I mentioned, the world price of crude directly affects oil and gas extraction and thereby the demand for Halliburton services. It really just translates directly over to the magnitude of your revenue in the commodity space. When the world price of crude, as you can see, kind of started tanking in 2014 through 2016, revenue just went right along with it, declined rapidly. We then saw a crazy rebound that we'll talk about a little bit later. But rising crude prices typically lead to increased demand for Halliburton support services. So as we do see that rebound, we can expect growth in Halliburton's business. Kind of looking at that projection out per IBIS World, the price of crude is, it's kind of regressed to be essentially flat through 2025. So we're not going to see a lot of revenue growth there for Halliburton. However, we take this with a grain of salt. It's regressed because fossil fuel prices are highly volatile. So that's on the oil space. Next slide, please. Nat gas is a similar scenario. We saw in 2008, through 2008, we saw the price of nat gas skyrocket. That was attributable to high oil prices, declining reserves, and concerns with greenhouse gases because nat gas is cleaner. Then we had the financial crisis in 2008, which kind of really turned everything around. At present, nat gas is in kind of a notorious state of constant oversupply. It's difficult to ramp down production of nat gas. Once a well is tapped, it's tapped, which has kind of kept prices suppressed. That said, the forecasts there are really only about 1.3% of growth through 2024. Next slide, please. And then the other side of that, price times quantity equation is the quantity. Oil and nat gas production is anticipated to moderate in the next 5 years from what we've seen some big swings recently at an annualized rate of 2.6% through 2024. And again, that should translate directly over to demand for Halliburton services. So we'll see less volatility in their business stream. Next slide, thanks. So all that said, industry revenue is expected to grow at an annualized rate of 10.9% through 2023. However, that includes a spike of 14.7% in 2019, again, as the industry normalizes, as I mentioned. So it's really misleading and inflated due to that sharp decline that we saw in 2015 and 16. So really, looking forward, as you can see in the graph on the right, we're kind of hovering around 3% growth, which is kind of that conservative estimate. So that's kind of where we stand there. Next slide, please. I wanted to offer this visual as kind of an opportunity for a buoy in Halliburton's business. There's been kind of this deviation between the S&P or the Russell or whatever other index you want to use relative to the industry. So I think there's an opportunity because the industry is underperforming to revert back up, once we see the business somewhat recover in the future. And next slide. Just to kind of close it out, I think the consensus here, it's a rather unattractive industry. It is volatile, as I mentioned. It's 20% more volatile than the market as a whole, which really isn't a surprise. But we do see a negative spread, 6.33% ROIC versus a WACC of 8.34%. And we see some big players like Schlumberger, that are kind of facing that situation as well. I'm going to attribute that to high operating capital requirements of the industry that's suppressing ROIC. So it's a question of when prices recover, will a return on invested capital recover. So now I'm going to pass it off. Warren?
Thanks. So I'm just going to go through the 5 forces now, and we'll start with threat of new entrants. So we expect this to be medium, and it's expected to decrease on a scale, assuming that high helps the industry have above average spread. So the industry has substantial working capital requirements, as Christian had mentioned, and also regulations regarding offshore drilling in particular limit participation to those able to obtain government approval. Now, bargaining power of suppliers is medium, and we don't expect this to change. Input costs are related to raw materials, and some of the larger players in the industry may have scaled to put pressure on suppliers for lower prices, as there is low concentration in the industry. Bargaining power of buyers is medium and expected to decrease. The industry has many players competing for contracts. Contracts are typically bid on by firms offering similar services. Price and quality of workforce or their track record are differentiating factors, and land drilling contracts have much more competition, as smaller niche players can compete for contracts based on price and expertise. Threat of substitutes. Renewable energies obviously are a substitute, but the efficiency isn't quite there yet for it to be a huge threat to the industry. However, the increased regulation does put pressure on margins in the industry and does encourage the innovation and development of renewable resources. And lastly, competitive rivalry is low and expected to decrease. So competition in the industry is high because of companies do all provide a similar service and must therefore compete on price and quality. And there's also a lot of international competition, and some of these players have a little less regulation to deal with in their home countries. And lastly, as Kristen mentioned, the industry is not so attractive with a negative spread. However, Halliburton does have a positive spread, and it is much better than their closest competitors, Baker Hughes and Schlumberger, and that's also reflected in their dominant market share within the industry. Now I'm going to pass it off to David to go through the CFI.
Sure. So here we have a CFI statement for the past 5 years for Halliburton. After posting positive NOPAT of $3.7 billion in 2014, Halliburton posted 3 consecutive years of negative NOPAT, bottoming out in 2016 with a value of negative $5.1 billion. The decline in NOPAT is largely attributed to the decline in crude oil prices from 2015 to 2017, where crude oil prices dropped as low as $35.87 in January of 2016. Further, as shown in the CFI statement, Halliburton's CapEx has been lacking depreciation. In total, Halliburton had an investment rate of 50% over the 5 years. Further, Halliburton has had positive free cash flow for 4 of the past 5 years, most recently posting positive free cash flow of $1.3 billion in 2018, with total free cash flow of $3.6 billion over the 5 years. Further, Halliburton has had positive free cash flow available to investors for 4 of the 5 years, with negative CFI of negative $6.8 billion in 2015. This was largely a result of Halliburton increasing interest-bearing debt by $7.5 billion in 2015. In total, Halliburton had $1 billion in CFI over 5 years. Next slide, please. So here we'll take a closer look at Halliburton's return on invested capital from 2014 to 2018. As you can see, Halliburton had a slightly negative ROIC of negative 0.2% for their 5-year total. This is driven primarily from both negative NOPAT as well as declining invested capital from $20 billion in 2014 to $13.8 billion in 2018. The decline in operating invested capital is from both declining operating and working capital as well as declining net PP&E. Next slide, please. So as you can see, by our 3 key drivers, end-of-year ROIC has been decreasing from 16.6% in 2014 to 13.5% in 2018, a delta of negative 18.5%. This is a result of a few key drivers. First, decreasing gross margins and increasing SG&A and depreciation are putting downward pressure on operating margin, which had a delta of negative 33.7% from 2014 to 2018. And second, an increasing invested capital sales ratio of 1.9% from 2014 to 2018 is also contributing to a lower ROIC. The increase in the invested capital sales ratio is driven in large part by an increase of 66.1% in intangibles relative to sales over the past 5 years. Lastly, a decrease in the cash tax rate did provide a benefit to ROIC, but still ROIC tends to be declining over the 5 years. Next slide, please. So now we'll go into our valuation. Oh no, now I'll pass it over to Kanuba for the multiple analysis.
Thank you, David. So now we did a comparable multiple analysis for the three companies to evaluate the value of the company using metrics of other businesses of similar size in the same industry. And the first analysis we did was the price to earning ratios, which is used by investors to determine the value of the company. And investors prefer a higher price to earning ratio because it gives a clearer picture of high earning potential of the company. So we look at Halliburton. Halliburton is trading at a discount compared to Schlumberger, which is at 19.78%, higher than Halliburton and Baker Hughes. And this we would say is as a result of a higher net income, and although the spread that we've seen in for Schlumberger and Baker Hughes is negative, and this can be explained by the short-term, long-term of return on equity for the two companies. And moving on to EV/EBIT multiple for the company, we use this analysis to measure the company's earning yield, and we did see that the industry does have a high tax rate, with Halliburton is 20.96, Schlumberger at 16, and Baker Hughes at 41. But the growth rate, the spread, so the return on invested capital for Halliburton is at 13.54%, and the observed EBIT is lower, and that could be attributed to the return on invested capital and the growth rate, which is at 2.2%. Schlumberger, on the other hand, has a higher EV/EBIT observed at 18.59%, which we think is, we can attribute that to the return on invested capital, although this industry experienced like a negative spread, and we had to make accommodations for that, so we can have a kind of growth rate which matches the model and the observed EBIT. And so based on the EV/EBIT, we can say that investors would prefer to go for Schlumberger because it has a higher EV/EBIT, and the EV sales multiple based on that analysis, we'll say investors prefer to go for a company like Baker Hughes because it has a lower EV per sales, and the operating margin based on productivity, we will say Baker Hughes is more attractive because investors will invest $0.4 to have a dollar return in revenue. And
all right, so we're kind of over time on our 15 minutes, so a couple minutes left to kind of wrap up the valuation.
Okay, so I'll speak to the valuations that we have done here. So we started with the as-is with the share price at $30.41. So that assumed revenue growth of 4.8% through 2019, EBITDA margin 18.3%, growth rate of 3%, and WACC 8.2%. We didn't touch the weighted average cost of capital for Halliburton at all. Next, our bear scenario, we pretty much assumed everything went wrong. Recession, oil prices go down. Their margins don't really go anywhere. So having done that, we had a share price of 9.22. Next was the bull, and of course that assumes that the economy picks up or continues to move on and does not fall into a recession. And with this, we used a revenue growth rate of 5.9%, EBITDA 18.8%, and there was a lot of guidance in their conference call as well as on IBIS regarding expanding margins within the industry, and specifically Halliburton because of their investment in technology and the track record of their management team. So this gave us a target price actually of 36.56, making it a buy with an upside of about 17%. And in that model, we had revenue growth of 5.3%, EBITDA of 18.8, and a growth rate of 3.
Okay, great. So if I liked your 5 forces with the burning down platform.
Oh, that was meant to kind of evoke. They had a hand in the. I was about to say the Exxon Valdez, Deepwater Horizon. They had a hand in that, so I think that was just meant to kind of communicate the highly regulated nature of the business as kind of a barrier to entry. You know.
But the real question is less about that, but more about just long term. Like, is this company kind of doomed long term as the world transitions away from fossil fuels towards clean energy?
Well, if you look at our bear analysis, that's why we had the continuing growth variable set to 1%. That's kind of assuming that they diversify into other lines of business. We didn't really see any indication of them kind of transitioning away from fossil fuels. So we kind of used just 1% as a baseline. I think that, yes, you know, the developed nations in particular are going to transition away from fossil fuels, say in the next 30, 40 years or so. But emerging markets simply can't afford that type of technology. And I don't foresee it becoming cheap enough to kind of help keep pace with their growth. India in particular is getting wealthier, but they're highly dependent on fossil fuels. Pretty much all of Africa is still highly dependent on fossil fuels. So I think Halliburton still has opportunities outside of the developed world.
Okay. So that's hence why your target price is what it is that short-term sort of growth outside the U.S. in the developed world.
Correct. Mm-hmm.
Now, in the fracking business, is Halliburton a player in the frackers as well?
Yeah, they are. They're actually a technological leader on that front. And that kind of, we didn't really get too deep into how that like affected their margins and margin suppression versus increases in margins. Unfortunately, we just didn't have time for that type of analysis. But they are kind of on the cutting edge of new drilling techniques.
Okay. And I'm assuming that the price of oil still is pretty having a big impact on their business. So if oil does get depressed again, then that probably moves them more into the bear range.
Correct. Yeah, and I think that's reflected in the margin value that we put there as well.
Yeah.
So we suppress that, assuming that, you know, we tried to make the point that their revenue is directly tied to the price of oil in the larger economy. So that's kind of where we saw that EBITDA suppression there.
All right. Well, again, this was actually pretty informative. So thank you for what you guys did in this presentation. So good job overall. All right. Final company, Nike.
Yeah, I'll take it.
That looks like a Word document.
Yeah, is that better?
Yeah, that's a Word doc. Oh, there it is. There's a PowerPoint.
Okay. All right, so we're group 4. We're Nike. So with me,
you put it in presentation view. It's actually in the presenter.
Yep. Let me swap it. Is that better?
Now better. All right, let's go.
Okay. All right. So we've got myself, Corey, George, Greg, Jennifer, and Jonathan. So with that, I will throw it over to George.
Thank you for the opportunity. Our company is Nike, and as everyone knows, Nike is an international athletic apparel and footwear company headquartered in Oregon, just outside the Portland area. Its major competitors are Adidas, Under Armour, Reebok, among many others. The market is quite saturated, and it has a very wide-ranging product assortment across several sports, such as running, basketball, and football, as well as other lifestyle products, even into iPhone cases and wristwatches. Go ahead to the next slide. So the first part of our analysis is the EIC analysis, and regarding the economic portions, our conclusions are basically that there'll be no significant downturn for the athletic footwear and apparel industry based on some of the macroeconomic conditions that we researched. And some of those are the
somebody's just crying on
yeah, is somebody crying? Okay. I'll continue. Some of the conditions include the U.S. GDP growth rate, which is expected to hover around 2% for the next 5 years. Another one is the Chinese, as well as the emerging Asian GDP growth rate, which is expected to be around 6% for the next 5 years, which is a modest estimate. I think most of the estimates have them above that. And finally is, of course, the beta value, which is 0.68 for the industry and 0.65 for Nike, which are well below 1. Go to the next slide. So regarding the industry, the apparel and footwear segment, we see that to be very attractive with an average segment spread of about 31 points. That's the ROIC to WACC spread, with Nike's being just slightly below that. And then regarding the current market landscape, based on the 5 forces, we have the intensity of rivalry to be high because the industry has a lot of large-scale legacy apparel manufacturing firms, and the market is very saturated as well as very mature. We have the threat of new entrants at being very low. That's because of the scale of the existing firms and, of course, the high startup, basically fixed costs associated with this type of industry, and of course, with new entrants having to compete against the long-standing established brand recognition of the other firms. Regarding the bargaining power of suppliers, we have that at low. This again due to Nike's scale as well as very, very diffused supplier base. We have the bargaining power of buyers and medium, and this is due to the low switching costs from the consumer standpoint, going from one brand to the other, as well as the relative power of large mass merchandisers buying at scale. And finally, we have the threat of substitutes at low, because low to basically negligible, because athletic apparel is very difficult to substitute, and it's hard to envision any products substantially replacing athletic apparel's role in society. And with that, I'll pass the presentation on to Jonathan.
Yeah, thanks, George. So I'm going to go over the 5-year, market or industry segment outlook. And based on some of the forecasts that we identified, as well as the outlook that we identified, there are 2 major shifts in the 5 forces. And that is power of buyers shifting from a previous or current medium more to a low, as well as an intensity of rivalry shifting or remaining high or shifting even higher. And these 2 shifts are largely driven from what we're observing in the industry at large, is a shift to online purchasing, direct to consumer subscription services, to name a few. So we imagine these technological advances allowing these companies to both reduce costs from a supply chain perspective, as well as hit higher price points by taking advantage of some of the spontaneity of consumers through these social media platforms. So we expect the ROIC to the WACC spread to at least remain stable or increase going forward. Next slide. So looking specifically at Nike, in the current market condition, Nike actually does not have or demonstrate a significant competitive or any competitive advantage right now, with our ROIC to WACC spread of only 13.04, which is obviously less favorable than one reported for the overall segment. The one thing that it's important to note is that Nike has the largest market cap as well in this space. And we expect this spread or this competitive advantage to develop going forward. And that's largely to initiatives that Nike is launching in 4 major areas. So product innovation, enabling technology, channel optimization, as well as new markets. because Nike has the largest market cap currently, as well as some of the largest following and brand loyalty with that immense size, we envision Nike being able to take advantage of some of the supply chain optimization and technologies through AI, more so than some of its competitors, as well as we imagine it being able to reach more and more consumers through its social media platforms, and again, increase their price points and increase that margin through that. And then I will call out some of their involvement in new markets and new segments. So MBA partnerships, movement into the World Cup, which is new for Nike, as well as sponsorship of specifically Chinese soccer leagues, which is one of the fastest growing markets as demonstrated in the economic analysis. And with that, I'll turn it over to the ROIC tree analysis.
Over the last few years, Nike has seen a 45.7% decrease in return on invested capital. And based on our evaluation, this is due to a couple factors. Since 2014, Nike has had a 130.3% increase in their cash tax rate. And this is primarily due to the tax rate going from 13.2% in 2017 to 55.3% in 2018. In their most recent earnings report from March of this year, Nike addressed this jump in tax rate and attributed this volatility to non-recurring items and the finalization of regulations related to the U.S. tax reform. And they also had a one-time tax on foreign earnings of $2 billion. Nike also saw a 7.7% decrease in operating margin from 2014 to 2018. That would lead to a decrease in ROIC. In 2014, Nike had an operating margin of about 13 cents, and in 2018, it went down to 12 cents. So this means over the 5 years, Nike was making a cent less in profit for every dollar of sales. This was due to a 10.1% increase in depreciation and a slight decrease in gross margin. Additionally, over these 5 years, Nike's invested capital to sales remained the same. So in 2014 and 2018, it was 27 cents. This means that they needed to invest 27 cents to increase sales $1, and it had little fluctuation throughout the 5 years. This means that over those years, Nike had no real increase in efficiency in their investments. And while this alone won't cause a decrease in ROIC, it won't help counteract the decrease in operating margin or increase in tax rate either. Next slide. For the historical CFI, over the last 5 years, Nike has seen a good bit of volatility in their cash flow available to investors, despite a relatively stable in comparison free cash flow, meaning that Nike brought in a steady amount but was able to allocate it differently. One thing we noticed when we totaled the numbers was that Nike spent more on share repurchasing from 2014 to 2018 than their totals for free cash flow and CFI. And since 2014, their share repurchasing total was almost $16 billion, which is $2 billion more than their free cash flows that they brought in. This is due in part to a 2015 announcement. 2015 announcement for a 4-year, $12 billion share repurchase plan. In 2016, Nike increased their investment rate to 45%, which we can see on the debt and equity side was likely funded by the $778 million increase in debt. Nike's 2016 fiscal report said that they invested heavily in digital brand marketing and customer-focused digital capabilities. In 2017, Nike increased their debt by $1.8 billion to maintain their increasing dividends and share repurchase plan. And you'll see in 2018, Nike had a significantly higher CFI of $4.6 billion, which was almost double the CFI for 2017. And this was interesting due to their $1 billion decrease in free cash flow from 2017 to 2018. The increase in CFI was due to the change in excess cash and net non-operating assets and liabilities. And on the debt and equity side, this large CFI in 2018 was due to an increase in dividends and a $1 billion increase in share repurchases from 2017. And now Corey will talk about the multiples.
Thanks, Jenny. So looking at Nike's multiples to competitors Adidas and Under Armour, we see that Nike trades at a premium to Adidas based on its 27.4 price to earnings ratio compared to Adidas's 21.4, but at a discount to Under Armour's 46.95. Its premium relative to Adidas is mostly due to a much higher spread. Nike's 53% return on equity for the next 3 years is nearly double that of Adidas, and its 8% cost of equity is lower than Adidas's 8.4%. Lastly, its 4.67% growth rate is higher than Adidas's, so Nike is presently projected to outperform Adidas in each key value driver. Over the same time period, we can see from the column labeled UAA that Under Armour's projected spread is expected to be negative based on an 8.1% ROE and 11.9% cost of equity, so any growth will actually devalue the company. Based on this alone, Under Armour should trade at a significant discount to Nike, so it's clear that analysts expect much better earnings from Under Armour beyond the 3-year period, which is influencing their estimates. The column on the far right, labeled UAA projected, reflects long-term key value drivers that would put Under Armour in line with its current PE based on analyst expectations. And its large premium relative to Nike would have to come from a much higher expected future earnings growth, mostly due to their opportunity to expand internationally. Next slide, please. Okay, so looking at EV to sales multiples, Nike's 3.07 multiple is higher than both Adidas's 1.76 and Under Armour's 1.66 due to its greater 13.6% pre-tax margin. When we look at EV to EBIT multiples, we again see that Nike's 22.58 reflects a premium to Adidas's 14.82, but a discount to Under Armour's 31.11. Its premium relative to Adidas is equally a result of expected growth roughly 1.1% higher than Adidas's, as well as a 4% better after-tax margin, which overcomes Adidas's spread being nearly 22% higher than Nike's due to their more efficient use of capital. Adidas has to spend only 20 cents to generate $1 in revenue compared to Nike's 59 cents. And it's the same thing here. So based solely on 2020 projections, Under Armour's EV to EBIT premium compared to Nike is again unjustified given its negative 10% spread, which is a result of poor productivity. The company must invest $4.21 to generate $1 in sales based on current 2020 projections, and also has after-tax margins roughly 1/3 of Nike's. So to generate an EV to EBIT multiple for Under Armour similar to market expectations, we again have to take a long-term view of the company. Using Under Armour's projected return on invested capital of 20% by 2023 and a more realistic future WACC of 8.2%, growth would have to be 6.5% in order for Under Armour to be appropriately priced at its 31.11 EV to EBIT multiple, as seen in the far right column. We again think this multiple reflects an overvaluation of Under Armour based on overly optimistic long-term projections. And from there, I'll pass it along to Greg.
All right, thanks, Corey. All right, now we're going to jump into the valuations of Nike. First off, we did an as-is. We have heavily leveraged the Bloomberg analysts, the experts, both in revenue growth as well as EBITDA. The tax rate, we used tax rate guidance based on the last earnings call, which they said it should be about 18 to 20%. We then lowered revenue growth and kind of backed into CVG to get an as-is price valuation of 82.96. Looking at the bull market, a little more aggressive, we see our a little bit higher valuation of 123.32. This is estimating in 2019 we meet our revenue growth based on what the experts are predicting, but in 2020 to 2024 we see 10% revenue growth, which is in line with what Nike saw in 2014 and 2015 and some of their better years. So continuing that stable growth. EBITDA, once it hits 16.2% in 2020, based on analyst projections, we're going to say they're going to gain those efficiencies and they're going to keep them onwards. So they're going to be able to leverage that long term. Tax rate, again, the basis was 18 to 20%. So bull, we said we're going to go with 18, a little more aggressive. And then the CVG was based on the multiples at an 18% tax rate, which turned out to be a 4.54% growth rate. And now Andy will take you into the bear and the target.
All right, thanks. So for our bear, we kind of, like everybody else, assumed a worst case scenario. So we actually went back and looked at what the recession impact was to Nike back in 2008. And they dropped down as low for a fiscal year to -1%. So worst case scenario, several groups have talked about a 25% chance of recession to hit. And most economists think it's likely to be sometime at the end of 2020. So we reflected that. EBITDA decreased. We assumed that they were unable to fully incorporate their technology and supply chain innovations, as well as decreased demand due to the heavy recession. Tax rate stayed at 20%, but we did assume that in 2020 Democrats would take office. The previous tax rate for Nike in 2013 was about 35%, so we increased that there in about 2021. WACC stayed the same. For our target valuation, for revenue, we did assume a recession, however, it would not be as heavy as what we saw in 2008. So revenue growth decreased steadily. So rather than getting all the way down to -1%, we brought it down to about 3% in 2021. It's not nearly as drastic. For EBITDA, we assumed that their margins actually slightly increased despite the reduced revenue, and this was a result of their streamlining supply chain, as we talked about in Part A, their efforts to cut costs. Tax rate stayed at 20%. This was assuming that either Trump gets reelected, or even if the Democrats were to win, the Republicans would still hold the Senate. And therefore, we assume that the tax rate stays the same throughout. CVG decreased slightly. That was a result of very slightly declining U.S. GDP projections, which accounts for about 40% of Nike sales and $14.8 billion in revenue in 2018, which gives us a overall hold value for Nike. Let's go through these, and that is our presentation. So that I'll throw it over to the professor.
Yes. Again, good job, just like the other teams. So appreciate that. So I know I didn't give you a competitor, say Lululemon. So my question is, how important is athleisure to Nike, and does that growth impact Nike's growth at all?
Yeah, I'll jump in. So, I mean, athleisure in terms of sneakers and athletic apparel, that's huge for Nike in terms of their driving their revenue. So other companies, that's part of why the increased industry intensity rivalry increased, because of companies like Lululemon and because of companies like Adidas who are really aggressively expanding. I don't know, Adidas just signed Beyonce, so that's going to cut into some of Nike's female, what they're trying to grow in the women's sector. And that's really all athleisure and sneaker products. So I don't have a percentage for you, but it's a major driver for sure.
Yeah, I was actually thinking about the other direction. So, I mean, there's clear barriers to entry in this business. I mean, look at how difficult it is to establish shoe brands. Under Armour is struggling with that. But I'm saying the other side of it is, when I mentioned Lululemon, like, seems like, you know, even work clothes that we're probably all wearing are getting much more casual. And that's what I'm saying. It's going beyond, you know, what Lululemon originally sold is just the casual wear trend. And is that a wave that Nike is riding beyond shoes to athletic apparel? Are they getting into more traditional athleisure-based clothing? That was my just curiosity if you guys picked up any of that when you were looking at them.
I could add one thing to that. They definitely are, but one of the things that was interesting to me is the ways that they're using artificial intelligence to streamline. We talked about streamlining their supply chain, but they're doing it in really unique ways. But they're using AI and social media combined to predict trends as well, and feeding that directly back into basically, I forget exactly the terminology they use, but automated factories that are now near or close to their clients, their largest markets. So as trends in fashion evolved, going towards leisure, things like that, Nike assumes that this AI technology will allow them to develop those fashions more rapidly than their competitors and kind of respond.
And they've gotten some criticism for like underage labor and stuff like that, particularly in Southeast Asia. I mean, has this automation kind of got them past that? And are they not really having those problems that they've had in the past?
So I wouldn't say, so that's definitely in the media, but as far as what they report in their 10K around their investments, one of their examples is what they call Nike Express Line, and I believe it was their Shanghai facility, which is almost completely automated. And again, it takes real-time supply chain data to kind of optimize what was going on. So they're definitely, I think, promoting all the investments that are going into the factories of the future.
Yeah. And are they 3D printing shoes yet? Do you guys know?
They have. It's actually on the slide. They are only 3D printing shoes, obviously, for the clientele in professional sports right now. But they view that as a price driver in the future, where they could make hopefully custom athletic wear for even amateur athletes at some point. Yep.
Yeah. Okay. Again, good job, Nike team, and as I said, good job to all of the teams. I know that 5 weeks goes by relatively quickly, and I gave you sort of some peripheral assignments at each of the parts of the whole. But I would just say I applaud all 4 teams for kind of following the process that I laid out and kind of giving some coherent messages that also were informative, because I learned some things about each of the companies, and I thought some of your insights were actually pretty good. I didn't see any big holes in any of the presentations. And so after this, I'm going to go back and look just to make sure all the files were there. But basically, I'll put up the grades on these presentations later tonight out of 40 points. And so generally, like I said, I think overall, I think you guys did a good job. And that actually kind of is representative of the class itself. Basically, we are over tonight in terms of our lecture. By tomorrow, I just need to make sure you complete those midterm exams by end of day tomorrow. And then other than that, you'll probably get some questions about grading. But the short-term answer is the online MBA courses are generally graded on a curve. So I can't tell you what the point score is until I see where the overall total points for the class are and look at the standard deviations against the mean. But basically, you'll see where you kind of stand at that point. And if anybody is at the margin, then I will post an extra credit opportunity so that it can actually get you over a hump if you're right at the margin. So look for that to be available to you guys sometime in the next few days once all the grades are in, if that is an option somebody else wants to choose. So before we wrap up, any questions or comments from the group?
Sure. Quick one. What for the midterms? What time are they due tomorrow? I think you said end of day.
I would just say end of day. Just get them in by midnight. It's fine with me, and I'll start grading them on a Friday because I know you guys probably have day jobs. So 5 o'clock might be. So I'll call it end of day.
Thank you.
Sure. Other questions?
I just want to say thank you. This was really informative. I'm at the end of my MBA, and I actually learned something new. So I really appreciated the insight.
Well, I appreciate that, and I know actually probably I don't know what your workload is on some of these other online courses, but I know I gave you a lot of work in a short period of time. So I would just say thanks all of you for keeping up on that. And as I said, the presentations actually, and I'll be honest with you, came a little bit better than I thought they were. So from that perspective, maybe my expectations were lower, but they were exceeded. And so that's what I said. Overall, good job, and good job by all of the teams. I mean that sincerely. I mean, there are a couple of minor things that I'll poke around, but overall, like I said, you followed a good process. I think hopefully, as he pointed out, you learned a few things along the way, and that's what's important.
So what are you buying? What are you trading into tomorrow?
Well, what's interesting of all the companies that you guys talked about, the one that's most intriguing to me is what's going on with Halliburton, and whether or not the market may or may not be over penalizing them in the short term. I want to kind of go back and look at that view. I think they pointed out to me. And Royal Caribbean, if nothing else, it just surprises me. And I used to work with them. How that continued zero tax really benefits them. Even though they have low levels of return, that opportunity and the fact that they're growing so much faster than the rest of the industry, that also surprised me. Like I would have expected Carnival to be growing just as fast as Royal Caribbean. And the fact that you guys pointed out that they didn't says that they must be doing something right. So, just a couple of things to look at. But again, the problem is, as you guys pointed out your multiples, the market tends to get a lot of this. So it's not like on the margin you guys found fire sales. But nonetheless, I do appreciate this. The only danger to all this is what you keep talking about in the EIC, the recessions. You know, everything is going through rose-colored glasses right now because we've just had 8 years of growth. And if the market basically starts putting a little bit different tint on these forecasts, then suddenly these buy ratings become sell ratings. So that's the only danger in all of this, is that we are still an expectation-driven world. Obviously, you guys follow that wave in the assignments, so we'll see how that means. But same thing even with CVS. You know, last week they got hammered because of PBM. You guys are basically saying, no, the real expectation is to move into healthcare. And people have to look beyond PBM and get into healthcare services. So again, I think some good insights. So I don't know, I'll take a more look on each of the presentations. But overall, good job. Again, as we wrap up, this was recorded. It'll be posted online. As I said, the grades for this will be up shortly. Finish the midterms by tomorrow, and all the other grades should be up by the end of the week, and then with the curve as an announcement. If you have any other questions, send me an email. But other than that, this will conclude our online MBA course in terms of our lectures. So thank you guys, everybody, and have a good evening.
Thanks.
Thank you.
All right,
Thank
take care.
you.
Thank you again.